Good morning, I'm Bill Hubard, Chief Economist at Trade.com, and welcome to our weekly market analysis here on Core Finance TV. And I'm joined this morning by, you're Marc Ostwald, aren't you? Chief Strategist at ADM Investment Services. Well, I guess, Mark, you know, we've got Auntie Janet, we've got Super Mario, we've got Mark Carney and stuff like central banks. Where would you like to start and with whom this morning?
I guess we should start with Auntie Janet. For the simple reason that if people were still doubting the comments that she made during the press conference last week, she reaffirmed her position. I think it was interesting, some of the people's market reaction, that people were actually quite annoyed with her. That
Yes.
She's basically put inflation into this mystery category so that she can effectively ignore it. But I think the important point here is to understand the Fed's determination. And it's one thing which has distinguished them from some of the other central banks, where we've had mixed messages from the ECB. The Bank of England has gone backwards and forwards and all over the place and looks extraordinarily reactive. The Fed set out its stall back in last December, and while they weren't ever on a preset path, they were pretty much on autopilot, unless we were going to see a sharp negative tone evolve in asset markets. In fact, precisely the opposite's happened, and that's made the Fed's job a lot easier. I think one of the things that people don't really quite appreciate in all of this is the weaker dollar has made it so much easier for the Fed to carry on raising rates while no one else is.
Let's just briefly look at a euro-dollar chart, but then I want you to continue with what you're talking about, because I guess the situation being, and we talked about this before, and I think I ended the conversation on, I guess probably before one of the meetings, and I found a couple of her comments almost far more political than strictly economic. And maybe it's me. I didn't interpret her comments on Tuesday as being all that hawkish. I almost interpreted basically saying, well, 2% is sort of a meaningless number, and it's there and it isn't there. We could raise rates and we couldn't raise rates. And then even since she's done that, we've had 2 out of the 3 Fed governors say, well, there's nothing wrong with rates. I guess it was Kashkari last night was basically saying, what's wrong with raising rates come December? And again, I know the market implying now 76% probability of a done deal. The bond market is backed up. But I mean, we're not talking a 10-year at 3.25. We're talking, and again, another 100 and 200-day moving average number, okay? So is that technical or fundamental? And also, maybe it's me. Did you think maybe on Tuesday she sort of said, well, Donald, up yours, Dolores. I don't mind collecting my unemployment on the 1st of February.
Well, I think certainly the underlying tone there didn't sound like she's really interested in being renominated for a second term. And to some extent, with the chaos that goes on Capitol Hill and in the White House, who can blame her? With the unpredictability there, which could actually create a lot of ructions in the economy. If at one stage they really go off the rails, it would make the job almost impossible to carry out. So why not let someone else take over the reins, and she can walk away from it. She's not exactly a spring chicken. But I think the interesting thing with this chart is a lot of that rally that we had in the euro owed to a combination of factors. First of all, we didn't get the Trumpflation trade that everyone had been anticipating. Secondly, in spite of everyone blowing raspberries at the Eurozone economy at the end of last year, saying the political risk is absolutely enormous, the Eurozone economy is still on its knees, it's going nowhere. And we all got surprised by actually the fact that the Eurozone economy is now the world leader in growth terms. It's not exactly punching out the lights, but it is leading the way. And so we had this big recovery in the euro. We also played down our rate hike expectations in the States. And then we've had this sort of turnaround now where we've got to this point that people have actually realized that the Fed is serious. There were some warning signs ahead of the Fed meeting, but it got really reaffirmed with the Fed meeting. And then you've had sort of other negatives emerging in the euro area, well, supposed negatives. I think economically and in terms of the inflation outlook, they're probably less significant. However, this rather messy Germany election result does mean that there's probably not going to be a government in Germany before Christmas.
Yes, at the earliest, I'm hearing.
And with the very divergent interests of the two smaller coalition parties, the Free Democrats on the one hand, under Christian Lindner, who is what one would call a finance hawk, i.e. he is definitely all for austerity, and he's also for, he's reaffirmed this week, he's for ejecting countries from the Eurozone if their finances don't come up to muster. You've got, on the other hand, the Greens, who are basically want everyone to be given a big hug from Germany and be supported. So the answer, the question then is how much, what prospect for Eurozone reform, which allows people then to doubt whether this bout of Eurozone growth is going to actually be sustained.
Well, we're looking at this, okay? You've given us a lot of the fundamentals. Now, we did see overnight a major technical move, okay? We saw Euro-dollar trade at 17.20, okay? Now, that's the 200-day moving average, and if you're Fibonacci, okay, it's the 23.8 of the 208 to 214 and the 38.3 to the 214, 216. So that held dramatically. We saw some very serious buying. Now, it may only be, again, the technicians, and the last I looked, it was at 1767. So we are seeing sort of a tug of war. And as you said, I mean, the ECB and all these people got to be quite pleased with the euro at the 1767 level rather than at the 121 or 122 level.
Yes, I mean, they will feel more comfortable, though it was interesting that Mr. Marcush from the Slovak Central Bank this morning was saying, well, we've got to weigh up the growth against what goes on, with the euro.
Yes.
And that's sort of like a counterbalance. I think the more important point here, which seems to have got lost a little bit in translation, and I've made the point before, but it's worth reiterating, and that's this. Look, if we have the Fed raising rates again in December, and say 2, not necessarily the 3, rate hikes next year, you're going to widen out that rate differential with the Eurozone, where I would expect no rate hikes next year. They can taper, but no rate hikes. This is the important point. You're widening out that differential. And then the rates that you're getting, particularly at the short end in the States, look so much more attractive.
Yes.
And you do have to actually wonder why you want the negative carry of holding euros versus the dollar. I think there is a battle royal going on here. I think part of it is actually because central banks themselves, the FX reserve managers, the sovereign wealth funds, have been very short of the euro because of the political risk, and they have been amongst the big contributors to that rally. It's nothing to do with anything other than positioning. And it's always worth remembering that in these markets, because sometimes there isn't a macro or political view. It is just it's positioning. Yeah,
because you saw the same thing again in the Treasury 2-year. So much of that move now to a 2-year high was basically people feeling they didn't believe a 75% probability. He said probably best case scenario is 50-50. So they were probably caught off guard. And again, also with the dollar, my feeling is before December, we still have 2 more non-farm payrolls, 2 more inflation reports, and also will we start getting some real statistics from the economic damage of the hurricanes? We've seen the devastation in Puerto Rico, but we really haven't had anybody say, well, what about Harvey and Irma?
Well, that's going to be the most difficult part for the Fed to navigate, because they're going to have a load of data, which in some stages you're going to see a big downward hit, and then you're going to see some big jumps, like housing,
on the
auto sales for this month.
Because Houston was the weakest. Well, of course, we know what happened with Houston, okay? So again, that's the first thing. And also, you were talking about Germany with the EFO. Yeah, we saw a downtick in the EFO, but that was pre-last Sunday's election.
Well, I think the thing the Fed will be doing in all of this is looking at the momentum in the US economy ahead of this. And that's where yesterday's data, particularly the durable goods data, is actually very important, because the shipments part, which is a bit which goes into GDP rather than orders, which can always be cancelled.
You mean like defense? Airplanes?
Well, it wasn't actually, there was a contribution, but I'm talking about the core
Yes.
non-defense capital goods,
Yes.
ex-aircraft. So with none of those, you've seen a 1.1% rise in July and a 0.7 in August. So you're talking about another very strong contribution from
Yes.
business investment, which is probably running at its best levels we've seen for many years. And the Fed will watch that very closely. It'll also watch the other surveys that we've had in regions which haven't been affected. I'm thinking specifically of the Philadelphia Fed
Yes.
surveys, which, it's not just that the headline index, which isn't a composite, was strong. It's actually that you saw new highs for employment intentions, selling prices, prices paid, business capital, and overall expectations is up at a whopping 55.
We had I think Sterling here, just very briefly, okay? Now, Bank of England. I think everybody's said it's a done deal for the 2nd of November, because we get that after the November. That'll be the quarterly inflation report. Again, a lot of people are talking both December and then again in February or November. My feeling is November, yes, but I can't see two in a 3-month period.
This is, I think, the important thing, which we talk about the Fed's rate trajectory. We talk about where the ECB is likely to go. But with the Bank of England, we seem to have gone into this rather myopic view of one rate hike and they're suddenly hawkish. Well, one rate hike and they may actually be done for another 6 months.
Exactly right.
At which point, we've got a whole load of Brexit negotiations
That's right.
which aren't exactly going smoothly. You have to ask yourself, well, all they've done, if they go in November but don't do anything again, say until May, which
Yes.
seems a reasonable
Yes.
expectation because the economy is not that strong, then you sort of start to question why you would actually want to hold sterling, particularly.
Exactly right. And I mean, I think we're looking at almost almost a 3-tick down move, in about 10 days here. And again, as you said, now whether right or wrong, I mean, on the front page of the Daily Telegraph, Theresa May talking about starting a trade war with the United States. Well, I guess if the negotiations were like that, with a trade war with the States, Trump's grandchildren, if it's anything like it with the link with the Brexit. I mean, as you just said, we seem to be the politics taking over, and even if the bank does, all they're doing is taking back the August move of 18 months ago.
And you basically say, well, that's basically a tacit admission that was a mistake.
Yes.
And we've still got all the credit problems. We've still got weak pay
Yes.
here. For as much as Mr. Haldane yesterday was saying we're getting pay and productivity into better balance, if you look at any of the surveys, it doesn't look that way to me. And as long as that's the case, then households are going to remain under pressure. Inflation is going to remain elevated. And here's the thing with UK rates, long-term rates, they're totally mispriced.
Yes,
Even if the bank actually managed to get inflation back to 2%, part of it will be base effects, you've still got 30 and 50-year rates below 2%. Now, somewhere along the line, an economy which has plenty of inflation in it, that's wrong. And those rate differentials in the long run will work against sterling, because if you start to raise those long-term rates, and this goes back to the euro as well, one of the reasons why we had the euro going up was because the 10-year US Bund spread narrowed down to 172.
Yep.
We're now back at 185, and I think this is the thing which will work with sterling. Once we start to see that drift wider, i.e. US rates will be, US long-term yields are above sterling ones, the people will have to ask themselves, why do I want to hold sterling?
Exactly right. And I think that's a situation, where, we got a lot to think about. And I think the key thing is you just said, the political situation, both here and in the States, of course, is absurd. Here it's a situation of, what will we hear, what will we see, and of course it'll be the first week of October, okay, on we've seen what Corbyn and the Labour has done, now we'll have to see what Theresa May is. So it looks like it'll be politics continuing here and also in the States. So again, my feeling being is, I still think it's only 50-50 for the Fed. Yes, August may be done, but then, as I say, here in the UK, I think we've got to wait at least another 6 months.
Yeah, definitely.
So, Mark, thank you for joining us, and have a lovely weekend, and we will see you next month. And thank you very much.